Good afternoon, good afternoon, good afternoon. How y'all doing? This is Antoine Smalls of Financial Blueprint. We are having a special live report, breaking news report. Today, I don't usually go live on Wednesdays, but today we have the Federal Reserve cut for interest rates happening today at 2 p.m. We are waiting for the current rate decision from Federal Chair Jerome Powell. We're going to take a look at some of the stock market reaction, as well as we're going to, in real time, review Jerome Powell's press conference, which starts at 2:30. And we're going to listen to his speech, and ultimately we're going to, deep dive into what he's saying, and ultimately how this then impacts the future interest rate environment, as well as the forecast moving forward after this Fed meeting. Just to give you guys some quick nuance, the Federal Reserve has been raising interest rates over the last 2 years due to the fact that we have higher inflation. We have seen that higher inflation impact everyone when it comes to mortgage rates, as well as inflation for home prices, grocery prices, cars, used cars, food prices when you go to the grocery store, etc. And that has impacted the economy, that's impacted the consumer, that's impacted you and me, as well as any other American across the United States. So it is breaking news report right now that the federal funds rate has dropped 25 basis points. The Federal Reserve Chair has dropped interest rates 25 basis points. So what we're going to do right now, and I'm looking at the stock market, and the stock market is moving upwards, right? The S&P 500 went as low as 658 this morning. It is now up towards 660, and it went as high as 661, 29 this morning. So we have a jump in the stock market due to the Federal Reserve reducing rate by 25 basis points. So the federal funds rate currently right now is now 4% versus 4.25% that which it was as of this afternoon. So the big thing here is not about the rate cut. It's about the forecast that Jerome Powell will put out in about 25 minutes as we get prepared for the official press conference. Right. So before we get to the press conference, we're going to take a look and deep dive into some of the analysts this morning and what they've said for the market reaction, as well as what is to come when it comes to interest rates. So let's get into that really quickly as we wait for the Federal Reserve Chair to get ready for his press conference, and we will go over that press conference in real time here on Financial Blueprint. If y'all liking what's happening with the channel, please subscribe, hit the like button, and share this content with someone that needs to hear it. This is very important to your future financial security as well as financial freedom. We just here providing all the information, the guidance when it comes to your financial blueprint for your success and ultimately your journey moving forward. All right, so let's go to analysts this morning. Was putting out a lot of information when it comes to the federal funds rate and the stock market reaction to the Federal Reserve low interest rates. And again, I report the stock market is now going up even further. We are now at the 661 level when it comes to the S&P 500 due to the Federal Reserve lowering interest rate 25 basis points. Let's get to the market reaction as well as the analysts this morning.
As we've mentioned many times this morning, is set to announce a decision on interest rates that is coming at 2 p.m. Eastern time, so not that far away. Let's bring in two economists with different expectations on this. Joining us right now is Veronica Clark. She's Citi economist. She's expecting 5 consecutive 25 basis point cuts starting today. And then Mark Vittner, who is Piedmont Crescent Capital chief economist, says that the Fed might be better served by cutting in just 2 of the next 3 meetings. Okay, let's convene our own FOMC meeting here today. And I would like to welcome both of the members here, and either of you can state your case. Veronica, you want to lay your case out first for why you think they need to do 5 consecutive cuts here?
Yeah, absolutely. I think the labor market risks have clearly shifted since they last met in July. And this has been a labor market that is very gradually weakening for a while. We are experiencing deja vu. We saw this same time last year. And you would be worried that we are just ahead of that next step, which is layoffs. Why wouldn't you be at neutral at that point?
You said that you thought these cuts would have started earlier this year.
Yeah.
May?
Yeah. We were expecting that at the beginning of the year. Of course, we had the tariff risk, the Fed a bit more worried on inflation, and it took a while to see that weakening in the labor market, but I think we've clearly seen that now.
Mark, why do you think 2 out of the next 3 meetings will cut, 1 won't?
Well, I think
that they should, I suppose.
I think they need to find balance. There's still a risk that tariffs are going to turn out to be worse than we've seen so far. And there's no question the labor market is weakening, but you're going to go ahead and cut today anyway. I think October is a game day decision. We see what happens with employment and inflation between now and then. And then I think it's also important that they get their messaging right, because long-term rates are really what's important here. The housing market is dead in the water. And if we don't get mortgage rates down, and we really need to get mortgage rates close to 6, what builders tell me, they really need rates below 6 in order to get housing going again. And you're not going to do that if you ease aggressively. If you ease too aggressively at a time when inflation's going up, long rates are going to go up, the curve's going to steepen, and you're going to accomplish more by doing less.
What do you think of that?
Yeah, I think it's a fair argument, but I think the way that we've seen the market reacting to the dovish labor market data that we've seen 10-year yields come down, and that's a market that's expecting the Fed to be cutting. Obviously, that's consistent with getting to something like 3%, which is what we're expecting, and that can be consistent with 10-year yields still coming down.
Neither of you have mentioned inflation. Do you not worry that that's a looming risk with the tariffs, or do you think that was overplayed from the get-go?
Well, I think it's a looming risk if the Fed eases aggressively, if they accommodate the tariffs, if they keep monetary policy modestly restrictive, then if consumers have to spend more on imported goods, they have less to spend on other things. And that's essentially what we're seeing right now. We're seeing that services prices, for the most part, are moderating. We had a little bit of a hiccup last month, but just a little bit of one. And people are spending less on services which are domestically produced.
But they're not spending less, so it means they're spending more on the goods that they are buying.
They're spending more on goods, and since they're spending more on goods, they have less to spend on everything else. And you think back to the 1930s when we had the last time we had tariffs approaching these levels. 75% of what we bought were goods, 25% were services. Today, 2/3 of what we buy are services and 1/3 are goods, only part of which are subject to tariffs.
All right.
So real quick, hit the like button. Hit the like button if you haven't already. Hit the like button. Just to report again, the Federal Reserve has lowered interest rates 25 basis points. The federal funds rate is now 4%. Right. Breaking news. The stock market has gone up a little bit. It's currently at 660.87. It has been moving up and then moving down. Remember, the 661.78 level is the 52-week high. So we're watching that level to see if it breaks that level today. It has not currently at the moment. We are currently still watching the stock market move up and down based on the federal funds rate being lowered by 25 basis points. What they're talking about here in this video, and this was this morning before the federal funds rate decision was announced at 2 p.m. Eastern Standard Time. If the Federal Reserve were to lower interest rates too fast, if there was a 50 basis point cut or 3/4 basis point cut, the stock market would react in a panic mode and panic way, which means that the market would go down, right? So the Federal Reserve has to be very, has to be careful about how quickly they lower federal funds, lower the rate, because of how the market would react, right? If it's a panic situation and due to higher unemployment, the Federal Reserve lowered interest rates too fast, and that then reacts. Then the yield curve would rise. So it's this interesting concept. You have the federal funds rate, you have the interest rates from the Treasury standpoint, and then you have the yield curve. So if you lower the federal funds rate too quickly, then the yield curve would react in a negative way, which means it will be higher. So even though they lower interest rates from a federal fund standpoint, the mortgage rates as well as bank rates will still stay elevated due to the fact that the yield curve is in a panic mode. So they have to be careful about how quickly they lower the federal funds rate and lower interest rates because you might have a panic sell mode when it comes to the stock market being at a 52-week high and very much at an elevated level. So again, the report, the Federal Reserve has lowered interest rates 25 basis points, which I think is good, but it's not about the cut. It's about the forecast. So we're going to wait. We've got about 20 minutes before the Federal Jerome Powell chair does his interview. We will be at the press. Well, we're not at the press conference, but we will be looking at the press conference, and we'll be able to talk about it in real time today at 2:30 Eastern Standard Time in about 20 minutes. Let's continue with the video.
Let's just throw some anecdotal evidence into the mix. Scott Kirby, the CEO of United Airlines, was on yesterday. One of the things he was talking about yesterday is that we did see a slowdown in the consumer, but that a light flicked at the end of June. Basically, the light switch went on and consumers started spending again and started traveling. What does that tell you about the nature of the downturn, the potential downturn, but the willingness for the consumer to spend if they can?
Yeah, I mean, we've seen this for a while now where the labor market is very gradually loosening. We saw the slowing in spending earlier this year. There is this story, this possibility out there that maybe there was just this temporary uncertainty. People were worried around the tariff announcements in April. They just pulled back temporarily, and we'll get this rebound later this year, and that's possible. But the fact that we've seen this loosening in the labor market for 2 years already tells me that is not improving. Until I see hiring picking up, I would be worried that we could get a bigger crack in the labor market. And if people are losing their jobs, then they cut back on spending.
Some people argue this away and say that this is a matter of a smaller labor pool because we don't have immigration coming in and we have people actually leaving the country.
Yeah, I think that's a big role in what we're playing a big role in what we're seeing. But there is no question that businesses are pulling back from hiring. It is a tougher environment for college graduates. It's been a tougher environment for them to find a job, and so there is a significant slowing in the labor market, but I don't know that it's as fragile as it appears because of the pullback of foreign-born workers.
Mark, I want to go back to something you said about the housing market, because we had the Treasury Secretary on yesterday. Scott Bessent said that is the thing that they are most interested in fixing, is getting the housing market moving again. You really think if they cut aggressively that will, undo any good that they're potentially doing because the long end won't follow along?
Yeah, well, we saw that in the cuts a year ago. Yeah. And I think that if the markets feel that the Fed is getting ahead of itself and that it's leaning too far on one side of the mandate, then I think that we could see that long rates would rise. And it really, if we had one or two very disappointing inflation numbers, that's all it would really take. And so I think it's important that they get the messaging right. And housing's not going to turn on a dime because we have this huge buildup in inventories of new homes, and it's the highest it's been since 2007. And so they need sales to pick up so that we can clear out some inventory. We still have a lot of work in progress as well.
Pick up our prices to come down. I mean, if the inventory is there and you have buyers who want to buy it, just not at that price, you can either adjust the mortgage rates or the builders can take a haircut on what they thought they were going to get.
Well, they're
not willing to do it yet.
There too, we need to find balance. I mean, there are essentially cuts taking place, and that you are seeing that the builders are buying down mortgages still, and they're offering incentives.
It's weird though, Mark. So you stand pat, you let the labor market continue to weaken, and that's how long rates come down. You can't cut rates. Let's raise rates.
Let's
raise rates so that so that long rates come down.
No. You don't cut rates aggressively. You find the right balance. You cut rates
really
in September.
Based on inflation.
And so
it's really based on what happens with near-term inflation.
But what we're talking about really is the dot plot.
So what he's saying is you don't want to be too aggressive lowering interest rates because it will impact the mortgage rate as well as just the overall yield curve in a negative way, which I previously was just talking about. So really quickly, all right, the stock market was at 661. It has now moved down all the way to 658. If you are a day trader and you traded down from that 661 level all the way to that 658 level, you made a good amount of money just now in that long dip down. So, right. So currently right now, we actually just dipped below 657, which is a day low on the stock market. So even though we had a rate cut, and this is a possibly sell the news moment in the stock market, is the stock market rallied all the way up to the Federal Reserve decision. It is currently now, it moved upwards, and now it's coming down at a very, very fast pace. We are now 657 and almost sitting at 656 if this continues to come down. So right now we might have a sell the news moment when it comes to the stock market, but we are still waiting for the Federal Chair Jerome Powell to speak in a press conference. Usually the market reacts in a very volatile way due to the Federal Reserve Chair's press conference, right? So it's not about the cut, it's about the forecast and what is going to happen moving forward after this meeting, which we have October, and then we have December to end the year of 2025 for possible additional rate cuts. The biggest thing for us at the moment is to pay attention to what Jerome Powell states in his meeting coming up, or his press conference coming up in about 15 minutes, right? So as we wait, we're going to now take a look at NVIDIA, what I would call the most important company in the world. China has blocked all NVIDIA chips to be sold in China. China is taking a very strong play. I think this has to do with the trade deal. I'm not sure, but apparently right now China is blocking NVIDIA chips. Let's take a look at China, how that's going to impact the United States, as well as NVIDIA and the chip tech sector, the semiconductor sector overall moving forward.
Times reporting that China's internet regulator has ordered tech giants like ByteDance and Alibaba to stop buying NVIDIA AI chips and cancel existing orders. That includes for a new China-only chip that NVIDIA had put together. NVIDIA just making some comments on those reports in a news conference. The CEO, Jensen Huang, saying, "We can only be in service of a market if a country wants us to be." He said they continue to be supportive of the Chinese government and Chinese companies as they wish. Joining us right now to talk about this, TikTok, and other technology stories is Lo Tony, Plexo Capital's founding managing partner and a CNBC contributor. And Lo, there's a lot of kind of stories that are whirling around this entire U.S.-China relationship right now. TikTok is this, the NVIDIA story is this. What do you think of this as an investor?
Well, this is an exciting week. I guess we have, monetary policy here domestically and geopolitical policy abroad. And the TikTok deal could be a blueprint for how we can thaw those tense relationships. Maybe, like to your point, China's holding on to a pun intended chip by doing what they're doing to restrict some of the chips from NVIDIA. So we shall see. But I do think that...
It's like it's all on the bargaining table.
Exactly. That's exactly where we are. Everything is on the bargaining table. And I think ultimately what we'll see is a new path forward to potentially ease those relationships a little bit.
What do you do in the meantime? Like, how do you play this? How do you figure it out? It's confusing, but do you think we're headed in one direction where maybe we get an opener relationship? Is that kind of your...
Yeah, I look at the TikTok deal, and although they haven't announced all of the details...
We don't know the details yet, and I think there could still be some disagreement between the two sides, and then trying to get that to Congress and say, okay, does this satisfy everything that Congress put forth in the law?
And I think, but ultimately, I think this administration is very deal-oriented and wants to see a deal on the table. I think we are seeing indications of that just by virtue of what's happening with TikTok. And I do believe that there will be some easing. And I think once those details come out from the TikTok deal, what we will see is that it's an opportunity for a little bit of face saving as well, right? And so, this opening up a little bit to the idea that we can actually house some of the data here. I think, to your point, the algorithm probably won't be fully exposed.
But I think that's the biggest question. That's what the congressional intent was all about, the algorithm, and not allowing foreign entities to have such sway over the American public, particularly the American youth.
Yes.
So as you see it, though, this is leadership for tech still continues in the markets? I
think so. Yeah, absolutely. When you think about interest rates, a lot of that has already been priced into the big tech companies. When you think about the movement of interest rates and how that impacts stocks, tech stocks are typically the most volatile on the increase or the rise of interest rates or the decrease, because they're very long-lived cash flows for tech. And so those so far out, when interest rates come down, those become more valuable. And when interest rates go up, you see the tech stocks get hit first, typically.
So let's talk about NVIDIA and China for a second, right? And if you pay attention, about 2 weeks ago, 2 or 3 weeks ago, I reported NVIDIA's earnings, and we broke down the details when it came to NVIDIA's beat, when it came to their overall revenue, as well as their miss when it came to their data center revenue. And the one thing that we seen was NVIDIA did not report Chinese revenue due to the issues with the United States government as well as the Chinese government when it comes to trade. We know President Trump put tariffs like crazy on a whole bunch of countries. Currently, right now, the United States is in negotiations with China when it comes to the trade deal between the two countries. And this may be another tactic that China is using to have leverage over the United States when it comes to trade, because the most important company in the United States is NVIDIA, right? And NVIDIA's ability to do business outside of the United States is important, right, to other countries. And China is one of the most, important, markets when it comes to technology and the future of technology, right? So NVIDIA did not report their Chinese revenue for the quarter that they previously did earnings. And it was estimated that the Chinese revenue would bring in another $5 billion. $5 billion would it be, right? So if NVIDIA is not going to be able to take in that money, take in that revenue, that's going to significantly impact their business, right? So sure, they still was able to do a ton of business with Microsoft, Meta, ton of business with some of the hyperscalers across the world, right? They make a lot of money. They have an amazing profit margin, but let's not get it twisted. The Chinese portion of the business is important, right? To continue to show profits, to continue to show increase in growth and estimated revenue over another 5-year span, right? So as an investor in NVIDIA, myself, as well as a whole bunch of other people, it's important that NVIDIA has the ability to do business with China. And it's important that the U.S. American and Chinese trade deal gets completed, as well as this TikTok deal when it comes to someone purchasing TikTok for the United States. That's also important to our president, right? So you had a lot of different variables at play here, but all of this matters to the overall stock market. NVIDIA is the number one weighted company in the stock market, which then impacts the total stock market index, right? So if NVIDIA gets impacted negatively, then the stock market will get impacted negatively as a whole, right? So it's important for us to understand all of these variables, how they impact not just the stock market, but also the stock of NVIDIA and the future growth in the company with this Chinese situation.
Jenny Jones was here from Franklin Templeton earlier. Yeah. Johnson was here from Franklin Templeton earlier, and she pointed out this idea that there's going to be a lot of tailwinds pushing stocks higher next year. The tax code for one, and then these Fed cuts that are priced in too. It seems like it'd be hard to bet against some of those things.
I think so for two reasons. Number one, I think that's right. The whole macro trend is very favorable for tech in general. But then you also just have the massive momentum of the adoption that we're seeing with AI in particular, which is really driving at both the infrastructure layer, which we see with stocks like NVIDIA, but then also at the model layer, obviously, Anthropic, OpenAI, and then applications. I saw you using Perplexity earlier. So I think, all of that stack is going to benefit the more we see adoption, not only at the consumer, but probably more importantly at the enterprise level as well.
So do we want China to really be good at AI, or are they going to be no matter what? Will they get it from us anyway? Is it enough of a to NVIDIA's bottom line? Do we want China to be able to buy NVIDIA chips at the risk of them leading the world?
Your first question, I think, is the key question.
Do we
want them to see? Because we formerly used to think of the ability for American firms to dominate so that we could hold our space in the economic pecking order. But now I believe that policy is very important for us to America to maintain leadership as well. It's also a policy decision. It's a national defense issue.
Is there any way to stop them? I mean,
well, there's no way to stop them. I think the ultimate thing for us to do is to have policies in place that allow us to most effectively compete. And I think that's what we're starting to see, the shift. The worry has always been that we go back to what happened with the internet, where it was very difficult because the policy was always lagging the innovation. We'll continue to see that, but my hope is that the lawmakers have gotten a lot smarter and understand they're never going to be able to have policy ahead. So sometimes the best thing to do is more of a laissez-faire situation, especially given, I think, the increasing importance of technologies like AI to our national defense.
But then you have something, right, that is so important that a laissez-faire attitude with that seems like the wrong way to go with some of these issues. We've had laissez-faire with social media networks, and now we're blaming social media for a lot of the violence that's here in this country.
And I think there's a good balance that has to happen, right? I think what you need is the ability for policies to allow companies to compete, while at the same time realizing that there are real consequences if we don't monitor what's happening. And I don't think that, I think there's an ability for those two to exist together.
My bad. We are about 3 minutes away from the federal chair, Jerome Powell, and him having his press conference. So let's just recap everything that's been going on, right? So the Federal Reserve chair has lowered interest rates 25 basis point, right? So the federal funds rate is now 4%. He did not overreact with a 50 point basis cut. He did a 25, which I think is a good start. What's important now is the forecast. So we're gonna, when this press conference begins, we're going to go live at the federal chair, and we will look at the press conference and we will deep dive into what he says. What's important now is to look at the forecast. The forecast for the end of this year into next year. The street is, which is when I mean the street, I'm talking about Wall Street is estimating that we will have 2 more rate cuts to end this year, which is in October and December, and then they're forecasting another 2 to 3 rate cuts for 2026. So it's important to listen to the words that he uses, and it's important to understand what he's saying, right? So you can tell by the things that he says if he's dovish or hawkish when it comes to his wording, and if they're going to be data dependent, which is probably what he's going to say. He's probably going to say that they're going to be data dependent and they're not going to make any forecast currently right now. But what's important is to look at 2 things: inflation versus unemployment. We know that unemployment's been going up over the last couple months, right? It's currently at 4.3%. We also know that inflation has not continued to come down. So the Federal Reserve's job is to make sure that we have lower inflation and we have higher employment, which means lower unemployment. So if unemployment's going up and inflation staying up, that's a problem. So what his decisions, or these decisions over the next couple of months, is going to be key, because if we continue to see higher inflation while the labor market gets worse and more people are not employed, that is a big issue when it comes to interest rates. Because do you continue to lower interest rates in that situation, or do you keep interest rates where they are? That's going to be the question that is going to be asked. And that's the thing that we got to pay attention to. And then how all of that will impact the stock market is yet to be seen. Right. So we got about 1 minute left right now in the stock market. We've seen it go all the way up, S&P 500 up to 661.72 today. It dropped all the way back down in less than 5 minutes to 657.13. It is currently moving upwards again. around that 660 level. So we're going to see the market reaction. We're going to see what the stock market does when the Federal Reserve starts to speak, which is going to be very soon. Let's see if he started already. Nope, he hasn't started yet. But they are waiting. Oh, he's coming out. He's coming out. Let's get this on. Federal Reserve is up and he is starting to speak. Let's take you there.
People. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation. And actually, the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say, if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So let's take a quick look before we continue on the his press conference. The stock market went all the way up to 661.78. It is now at 656. So that's a $5 dip in the market just in the last 10 or 15 minutes. And just, I just traded a quick little scout, made about $800 and got out. So if you are day trading in this very volatile day when it comes to the Fed chair's report, definitely be careful, but you have the opportunity to make some good money. So what the federal Fed chair basically stated in layman's terms is that there are two issues here. There are higher inflation as well as lower or higher unemployment. And he has to balance out the two. And he's trying to do his best by doing that, by only lowering 25 basis points. 50 wasn't really a part of the conversation. 50 would have been an absolute overreaction, and the market would be bleeding a lot worse than it currently is right now. And he's answering questions based on the politics of things when it comes to the president and the politics, as well as what they're asking is what is the possibility of a future 50 basis point cut in an emergency situation. Again, emergency situations are not a positive to the stock market, and it's not a positive to anyone. But we do have higher underemployment. And he stated that unemployment is supposed to rise to 4.5%, something to pay attention to, right? So we're currently at 4.3%. By the end of this year, he's saying that 4.5% is the estimated forecast for unemployment. It's not good, right? So higher unemployment, higher inflation. He's hoping that tariff inflation is only a 1 or 2 month thing, but it's a possibility that tariff inflation will be something that sticks with us a little bit longer than just that 1 or 2 months. Again, hit the like button, subscribe to the channel, share this content when someone needs to hear it. We are live today, right now, on the Federal Reserve Chair report and press conference. Let's go back to the press conference.
So just looking at the SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low, it's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that the basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened, So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market. And so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market. And obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins. So kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you gotta be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right there that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. And people they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a 0.25 percentage point now is going to arrest that?
Well, I didn't say that I thought a 0.25 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minority unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
All right, so we're going to end the press conference. I believe it's ending in about 2 minutes. As you can see, some other people got some questions. What I will say is, to summarize this meeting, is very important that we understand. You have higher unemployment, which he is leaning in that direction. The reason why he's lowering interest rates starting this month and is looking like October is almost a guarantee, another 25 basis point cut. He didn't say that, but if you listen to the type of tone, how he answered some of the questions, I think October 25 point basis cut is in the cards for sure. He talked about he has to lean to the higher unemployment because that is the concern. That's the bigger concern currently right now versus higher inflation. Being that we have 4.3% and then a forecast of 4.5% as of this year when it comes to unemployment. That is where the Federal Reserve decision lies, right? So if we continue to see higher unemployment, I think we will continue to see rate cuts at least in October and possibly also in December of 25 point basis cut. I do think all in all, the press conference was pretty neutral. He tried to provide balance. The type of words he was using was, I have to weigh both sides. It's like a seesaw. I'm looking at one side versus the other side. But I think that the higher unemployment is causing them to lean in that direction, right? So it is something to take in consideration as we continue to give out the information when it comes to CPI reports, PPI reports, inflation reports, as well as unemployment reports. We are doing everything here on Financial Blueprint. Again, as I reiterate, hit the like button, hit the like button, hit the like button, subscribe to the channel. Currently, right now, the stock market dropped all the way down to 654.30, S&P 500, the SPY. It is now recovered, a V-shaped, W-shaped recovery all the way up to 658.61. Currently, it is very much, in my opinion, a neutral reaction to the Federal Reserve meeting press conference. It did take a rise when the 25-point basis cut was announced. It then dipped all the way down, significantly down, while the Federal Reserve Chair was speaking. But now that he is almost done speaking, the market has recovered. It is only down less than 0.15% on the day, which I think is a positive thing for the stock market overall. Lower interest rates is a good thing for the stock market. If you are currently investing into the market, as I always say, invest. Understand the 3 to 5 great companies that you want to invest in. Put the money towards those companies. Let them companies make you money long term. I love you guys and I appreciate you guys. This week, we may do a stock market review on Friday. I'm not sure. I'm leaving town actually right after this live. I should be back to do that stock market update on Friday, as we always do. This is Antoine Smalls, Financial Blueprint. As I continue to tell y'all, be better than you were yesterday, be better than you were yesterday, and be better tomorrow than you are today. Continue to support the channel as we continue to grow in this journey together. Again, a new episode of Wealth, Money, and Riches will be on Tuesday next week. Continue to dive into the channel. Continue to look at the videos I've already uploaded. I have different playlists, different things that you guys can tap into. I love you guys. I can appreciate you guys. I'm out. Talk to y'all later. Peace.